Welcome back. A slowing economy, uncertainty over whether Britain will remain in the European Union prompted the Federal Reserve to step on the brakes on an increase in interest rates. The Fed lowering projections on how much short-term rates will rise in the coming years. I want to bring in John Hilsenrath right now. He's chief economics correspondent at the Wall Street Journal. And John, one of the takeaways from my standpoint when I was listening to Janet Yellen yesterday was the fact that she pointed out very weak business spending.
Oh, yeah.
You know, and we've talked about this a lot. When you see businesses not investing in IT and not investing in R&D, that tells you they're sitting on cash and they're not going to be hiring workers. They're not going to be generating growth.
Maria, I think you put your finger on a really important point. It's very much on Janet Yellen's mind, and it's why she's taking this slowdown in job growth so seriously, because the slowdown in job growth that we saw in the last jobs report didn't happen in a vacuum. We saw not only slow consumer spending but in the first quarter, but very anemic business investment for 2 quarters in a row. And she's trying to figure out what's going on there, and it's why she's, you know, taking her finger off the launch button on interest rates.
Yeah, and James Freeman, one of the issues here in terms of connecting the dots is regulation. And I bring this up a lot because you're trying to connect the dots as far as why we're in this holding pattern in the economy. Businesses are not spending because they have a whole new host of regulations, and they've got the cost of Obamacare.
Right, and as you said, they've got a lot of cash, they've got low rates. Interest rates are not the issue, right? It's costing us $1.9 trillion a year to comply with federal regulation. This is bigger than the GDP of Canada. On top of that, you have the highest corporate income tax rate in the industrialized world. We need to start looking at places other than interest rates. And I guess, you know, with Kansas City Fed President Esther George throwing in the towel, I guess it's now unanimous that we shouldn't have a rate rise now. But I think you could have. You'd still have rock bottom rates. But as you said, it's not interest rates. That's not our problem right now. You need the tax and regulatory burden to get reduced.
The problem is they don't have a whole lot.
Maria and James, I think that's a really important point, because what the Fed has been doing, what central banks around the world have been doing since the financial crisis, is trying to stimulate demand, not only with low interest rates, but with these bond buying programs. And what we're slowly seeing them come around to is the idea is that the supply side of the economy isn't functioning well. We don't have worker productivity growing as fast as we would like. We don't have workers coming into the labor force. And if we want to get the economy growing faster, we got to juice those things. And that doesn't come from boosting demand. It comes from things like regulation. It comes from things like infrastructure, education,
How about
tax rates.
Reform, John? Yeah.
That was my last one, tax rate. It comes from all these things that the Fed doesn't control.
Right.
That's right. Yeah, you end up tinkering on the margins because money is incredibly cheap, but business is not investing. They're drowning in uncertainty. And this administration, they're not going to decrease regulations. They're only going to increase them. Tax rates are going nowhere and unchanged, and the tax code's only getting more complicated. So
it really depends on this upcoming election. Bottom line.
Yeah.
Bottom line, John, is there anything that you heard yesterday that gives you an indication for July, for the next meeting, for the next time we'll see interest rates go up, or are they off the table for 16?
Well, you know, so Janet Yellen said July is not impossible. That means it's highly unlikely. You know, I just wrote a column today suggesting that she's one of the 6 people who thinks that at most we're going to get 1 more rate increase this year at most.
All right, we will leave it there. John, great to see us. Thank you so much. John Hilsenrath.